Hey guys, thank you for joining another Wednesday here with Multifamily Freedom Chasers. We're here to discuss brokers or engaging with brokers, deal sourcing, and underwriting. Topic we love talking about every other Wednesday at 8 p.m. Eastern. My name, just as you guys can see on the screen, my name is Edward Shamirian, based out of the lovely and chaotic Los Angeles, California. Um, Operator brokerage here, have multifamily experience on the transactional side and acquisition and managing my own, plus from a property management company, everything from shopping centers to apartment buildings to single family homes to managing land, all of the above, commercial spaces and whatnot. Um, Been in real estate for about 5 years now. Yeah, just over 5 years. Own property over here with Kevin on as a GP on a 120 unit in Florida. You guys may have heard us talk a lot about it in the past, and you'll probably hear us talk about it more, to be fair. Um, but yeah, that's some the stuff we're looking at and what we're working on. As much as I would love to play in my backyard and have stuff here, I definitely feel like Florida, East Coast, Sun Belt is a much more fun, better returns and place to look at property, but that's just personal experience at this point. But yeah, that's a little bit about me. My Instagram email is there. My phone number is also in my name in the chat, so feel free to reach out to me.
Yep, and then my name is Kevin Kohler. Been a commercial real estate broker now for 7 years, almost 8 years now. And as I had mentioned, general partner, asset manager for 120 doors in Florida. Currently under contract for another 72, and my real estate team services the entire country, focusing on Sunbelt states with asset class agnostic. We're just good with being able to review opportunities, hunt them down, work with sellers, buyers, and investors, and looking just to make deals happen for anybody, any of the stakeholders out there. We have a property management company as well that's located in South Florida. And beyond that, we have interest primarily in the multifamily space, which is why I've joined in as one of the leaders here of MFC. But also a heavy interest in hospitality, which covers hotels, restaurants, and event spaces, and special purpose properties such as car washes and sports facilities. So we're here to discuss with you guys, as I had said, the broker underwriting, deal sourcing, and the broker relations. Sorry, but my information, I believe, is still on the screen. I cannot tell because I am driving. But just reach out to us if you have any questions. And you can always schedule a one-on-one call with me by going to www.chatwithkevin.com. And always happy to discuss any and every topic with everybody.
Sorry, I was muted.
Ed, you're muted.
Yeah, real quick, some of the housekeeping stuff. If you guys can turn on your camera, if you have questions, please put them in the chat or raise your hand, and then we can get that more interactive and get you guys to talk to us directly and more engaged in that sense. Makes it much better, in my opinion. And then if someone else has ask a questions you want to answer, or just put your 2 cents, or you had a similar question and you want to go off of it, just let us know. We'd always love to connect with you guys. All right. So this is the Florida deal we mentioned. This is just some of the returns, general idea of what the deal looks like, and what we look for. And if you guys have more questions about that, please let us know. We'd love to connect with you guys on it. Whether you guys are investors yourself, or just reach out, and we'd love to go over it. And then here's the team. Here's everyone's Instagram. You'll be able to find us over there. Easy to connect, reach out. Also we have a schedule here every Monday and Wednesday. Somebody, we're gonna have someone on the call. We always have a call Monday, Wednesdays, 5 p.m. Pacific, 8 p.m. Eastern, same time every week. And on both those days, as you can see, you have either the activation, the asset management, or financing, or with us, deal sourcing and underwriting. So Monday, Wednesdays, 5 o'clock, you can find us consistently. Spotify, Instagram, WhatsApp, Facebook, YouTube, as we mentioned. If you're not in the WhatsApp group, I recommend scanning this QR code, get you directly into it. Good way to connect with people. We have a lot of great people in there. You never know who you meet. I found this 120 unit deal basically came from this group. It was just the seed that was planted. So you never know who you're gonna meet, what's gonna come about from those interactions, and where it's gonna what's gonna come out of it, you know? So connect, network, and always feel free to reach out to us. Um, so one thing I wanted to talk about, or we want to talk about today, that would help if I was sharing the screen. There we go. Um, so one thing we want to talk about was with underwriting a deal. I think one thing that we get very caught up in, and also gets a little tricky with, especially in the beginning when it's juggling, talking to a broker, getting the information, knowing what to ask, the nerves of also, hey, do I have the answers to all the questions they're gonna ask? Do I have, um, can I build that rapport and make sure that they're going to give me the information needed? One thing that I've actually really big on, I feel like this does help, is when you're looking for stuff, when you're looking to underwrite a deal and looking to talk with a broker or get more information or whatnot, a good way to um, ask questions and find out where you can keep the conversation going and build a little more credibility is when you are able to um, get the documents you need, do a quick glance at it, and say, all right, because of X, like these are where I have questions, X, Y, Z. Or hey, do you have ABC document? And we'll kind of go over what that looks like. And at that point, you're going to be able to build that connection, be able to discuss the deal, say the things you do and don't like, or maybe why it wouldn't fit your buy box or fit what you're looking for, and then be able to say, hey, I'm looking for this instead. And then that's how you get up to their list, makes it easier to source deals and makes it much easier to get that influx of deals from different brokers and then obviously find the best one and hopefully find a good one. And that's kind of our goal, right? So what I'm showing here is the calculator that we use most often, the microblank STA. It's the most common. It's one that I've seen most people request or have asked, like, or use as a reference point, to be fair. And it is fairly user friendly once you get comfortable with it. So one thing I want to do is not so much go through the calculator itself, but what you need in order to make this process very easy, um, and then be able to essentially analyze the deal. Because you may be able to underwrite as fast and as great as anyone, but if you don't have that right or accurate information or all of the information you need, it's useless, right? It's like playing basketball without the hoop. You're not going to score. It's going to be a little tough, right? So that's kind of what we're looking at here, and what we want to kind of go over. Um, but I'll use this as a reference just to show for anyone that uses this calculator where those little components are and why it's so important to know what to look for. Anything to add, Kevin, up to this point?
No, sir.
All right, cool. If you guys have questions, please put them in the chat. Feel free to throw it in there, and I'll keep my eye on it so I can answer it as we go. So obviously we're gonna start from top, always having the ask price. it helps. One thing that can happen, I see this happen on the residential real estate side. I see this happen in commercial, in any which way you look at it. Anytime you see a price, you're gonna have this preconceived notion of it. Um, don't give that price so much weight, because at the end of the day, especially in a commercial where it's way more straightforward, that's just a guide and what they're hoping they can get. If you aren't close to that, be honest about it to a certain extent without being disrespectful, obviously, because you still want the broker on your side. But keep in mind that, like, if you're substantially over for whatever reason, that should also be another red flag, maybe. Like, double check, because I've seen that happen. But it's like they're asking 10, I can offer 13. Why is there a big discrepancy? I would like double check. Like, make sure everything's right, your comments are in the right place, your X's and O's are accurate, right? Because literally one number could change the entire equation, especially when you're dealing with percentages. So the asking purchase price is always important just to have as a guide, because it tells you kind of where you're at within the ballpark. Also, depending the broker, they and more experience or someone who has better rapport with the seller, or sellers more willing to agree with what the broker's price is, you're usually gonna have a lower price. That you're gonna A good broker is gonna want a lower price to be able to create competition. A broker that just listed at whatever any seller wants is gonna list it at whatever they want, and that's usually gonna be on the high end, naturally. It's just for you to dissect the numbers and see what works for you. Obviously unit count, that's a given. And mind you, in this calculator, I want to point this out too. The only thing you're changing are the things in the blue, unless you really know what you're doing. And I want to preface that with that, because there are times I'll play with the other stuff, but it's either a copy or I'm like, okay, I know what I'm messing with, and I know how to reverse it if things go wrong. So keep that in mind as well. But you're only editing the stuff in the blue, okay?
And a
Price.
lot of that is also because, sorry,
No,
it's
no, go ahead.
because the the stuff in black is usually connected to a formula from a different tab or other things. So you don't want to break any of the mechanics in these more complicated underwriting models. Instead, you want to take it slow and just review everything before you start fiddling with every cell of the spreadsheet.
Yeah, and that's a good point too. These formulas, once you break one link off the chain, the whole thing crumbles, and that's not fun. Um, then you put the down payment. Where this down payment, not to make it more complicated, but where this can change and where you want to have like a lender in place, or talk to someone who has a little more experience, and it says, especially if you have a loan assumption, is you want to make it as easy as possible where your down payment and your numbers are reflecting what the loan assumption amount is. And remember, the loan amount doesn't change, but if your purchase price changes, the down payment percentage changes. So don't assume you're gonna have the same down payment regardless of price, or vice versa. It's reflecting on the loan you're acquiring. And that also helps when if you're getting new debt, to have a lender you trust, have the communication with them, know what they want, and kind of not do a full underwrite with them before, but get an idea of like, hey, this is the ballpark, this is where the SCR has to be at, which is going to be a big component in a lot of the lending nowadays. So knowing those things are going to make this process a lot more you get a lot more comfortable with it and get as accurate as possible. It gets tricky when you have no idea what your loan is, if it's not an assumption to underwrite, because a large part of that is going to affect your cash flow, which is going to affect your returns, which at that point it's a snowball effect, right? It's going to affect your raise and everything. Interest only months. This is easy to forget and like not plug in, and don't put 5 if you're doing 5 years. It's got to be 60. Again, bridge debt, assumable loans, that's what these are factors. And like this is a 750. This is just an example on a different deal I was looking at. What happens if this is 7.5 million? Those interest only months matter, and they make a difference on returns. Especially in the beginning when you have funds that you're trying to put into CapEx, you're gonna have vacancies. Yeah, okay. And stuff like that, such as that, right? Because you're definitely gonna open a can of worms with that. All right. So make sure that you have this number, you're accurate. Repairs, that is we've had this conversation a lot of times, but with the repairs is you want to get the best estimate you can, but make sure it's realistic. Like we all live in the cities we live in, and if someone told you it's gonna cost you X dollar amount to repair XYZ, you have a general idea whether that's ridiculous or in the ballpark, right? Even me being in LA, I'm gonna be like, hey, that's a little crazy, or hey, okay, that's a price that might work, or a little reasonable, or why is this so low? So I'm not saying go line item by line item, but if someone tells you per unit it's gonna cost $4,000, I don't know many places that works personally. Now, if they tell you 1520, I'll be like, okay, where are these properties? Like, where is this? Where are these units? Where is this building? Why is it that number? So really, really keep that in mind when with the repairs, you're never going to be 100% spot on without seeing it and accept that. But it's better to overestimate than to just, I'm putting this number because it makes my deal work. That's the worst thing you can do. Always for anything, repairs, lending, expenses. I don't care what it is. If you're doing something just to make the deal work, you're doing it wrong. And I'll be the first to say that. And then reserves,
I
be
would
very,
have to agree.
yeah. Because you get a lot of situations where, oh, this deal looks great, and then if you show it to investors or other people in different groups, or you bring it into masterminds, whatever the case is, or you're trying to raise capital for it, you're gonna get questioned on these numbers. People care, especially when they're putting their money into a deal. Um, which when you're raising money, that's gonna be the case. They're gonna ask you the questions that you may not have thought people would ask. Quick story. The first time I pitched a deal that was like 900 some odd units, um, I was definitely not as prepared as I should have been because I didn't know what I was getting myself into. And when I say I got gut punched so hard, I really questioned whether I was like, I'm like, do I really want to keep doing this? Yeah, it was not a fun experience, but I definitely learned a lot. And I was like, oh, this isn't really a game anymore. Like this is the big leagues, right? So I learned the hard way. Um, going to this one, this is one that without realizing can screw up a lot of the calculations when you are underwriting, and I'll show you why in a later tab. But also this is important because it is tied to another tab later on the bottom, and I'll show you guys where. Um your gross potential rent is not what it is receiving today. It is what your market rent is today. And I'm going to repeat that. If you have a unit, let's say it's 10 units, the average rent is 1,000, but your market rent is 1,500, you put the gross potential rent as if it was 1,500, and then you reduce the vacancy, concessions, loss of lease, bad debt, you reduce it on these two lines, and that's how you come to the gross potential income, which is your actual, let's say, $1,000 per rent. Why that is because your increases and the percentages and the inflation and all the X's and O's going forward over year to year is reflective off of the gross potential rent. And that's exactly what it's in the name, gross potential rent. And then you deduct everything else, such as a vacancy, concessions, loss, lease, bad debt, that will then get you to your final income. Now, you guys might think, okay, you're just going through this calculator. The reason why this beginning part is so important on this calculator and shows it much like very easily is this is where the rent roll will really play into part. Like you need the rents to know this what they're actually receiving, and the T12 to know where what concessions they're giving, what their loss of leases, what their bad debt's one that you can never guess. Concessions and bad debt, unless you see the numbers and see their documents, you're never going to be able to guess that because that's impossible. You don't know unless you get their information. Um, Vacancy percentage is another one that's going to be reflected on the T12. You get an idea of what the current vacancy is, obviously, with the rent roll. But that's why having up-to-date numbers and documents is so important. So that's where you're gonna find the data for these two. Um, where it gets a little tricky, and I guess this is Kevin, I guess you could jump in with this, is when you're plugging the number in on the income, you're plugging in today's. Don't get like, yes, you want data for the last 12 months, but this number is what you're inheriting. So you want today's numbers plugged into this calculator because what they did six months ago and has basically, you may not have the same tenants, you may have fixed some of those problems or had new problems. They're not going to really affect you. You want to know what you're dealing with today going into the property if you were to get the keys tomorrow. Just the life of escrow, so much will change. That is just things you have to accept, and hopefully you and the seller or seller's agent have good enough communication where you guys are on the same page. You can have an escrow as short as 3 months, as long as 10 months. If it's a 10-month escrow, they're operating as if they still own it, which they have every right to, and they should. And you hope that's the case, because the alternative is they don't operate at all, and then you have another problem in your hands. Like a property can go bad from good to bad real quick, to be fair. Um, anything on that, Kevin? Just like regarding that?
Yeah, I mean, I'll start with that last comment, and yeah, like it could go bad, good to bad quickly, but we all want to believe that sellers inherently want to provide you, at least a property at the condition and rent roll that you put the offer in at. I mean, America is a very litigious society, so if they just let it fall apart, then yeah, they're gonna get sued. But what you have to bear in mind is like Ed had said, so like the on this specific side by side scenario calculator, you've got your marketing package on column number one, or and that one is if there's a broker involved representing the seller, generally that's what you're either using from their OM, their offering memorandum, or you take those numbers from the T12, the trailing 12-month financials. And then the other columns, all the other comparisons are based upon different variations of what you think it will do at market with your budget, etc. Some of these columns are best, like my personal move is I usually rename some of these from like my version and projected and offer, and then use some columns to like stress test the deal. Like what if you take over the deal and something happens and your vacancy drops, or do you have to hire a property management company that's a higher fee, or different whatever expenses. You're able to at least take those and look side by side and say, okay, this is what the seller is dealing with now. This is what I'm expecting if all runs smoothly. And then this is what I'm expecting if things, go sideways after I take over the property. And so you can make sure that you're insulating yourself from risk, because again, we're all using these calculators to be investors. And so we want to be smart with our money, smart with the other people's money that are maybe coming along with us. And we have to insulate by reviewing all potential options. So the gross income, get that to be related to your rent roll, where you think it's going to go. Maybe have one column be your more optimistic approach, but don't be using that optimistic one to sell your investors, because as Ed and I love saying, you'd rather overpromise or underpromise and overdeliver versus overpromise and underdeliver. You want to set yourself up to look like the hero, not like the villain. So we always want to protect our people, and some of the more careful things would be like row, what is it, 25, other income. When you read a T12 and you see the different fees they might be charging, that other income is going to include things like collections and bad debt, being able to recoup any bad debt and different things. So you want to make sure, like, do those things actually translate over, or should I only take the the pet rent and the utility reimbursements and what all these other things that might be built into a lease. Like, do you only want to show that and then let the other stuff be extra income that you're not accounting for? Because again, that's protecting you down the line. So a lot of people I see, they just take the number over and then they add on to it because they just assume that they're going to be able to add more fees to the leases. But Florida is a state that when you buy the property, you have to honor the lease until it's done, until that lease expires. Some states, when you buy the property, you're allowed to go in and immediately change the terms of the leases because you're a new owner. So you want to make sure like what the regulatory legal frameworks are as you're going through to underwrite your deal. I think that's pretty as deep as I feel I should get on this topic right now.
No, for sure. And again, sometimes like I'll like going back to it real quick is the owner may be selling for reasons out of their control or some life happened, whatever the case is, and not always intentionally, but if they take their eye off of it, the property will, you're acquiring something different than what you initially had. So keep that in mind, keep the communication lines open, um, and make sure that you're just on top of it. And I think that's the best way you can go about it. Um, I like the point about the other income because not all other income is good. That may sound weird. The reality is like you never want to inherit a property. It's like, oh, the other income or additional income is high because we collect a bunch of late fees. Okay, that sounds great, but why are people late all the time? Because eventually those people who are late are going to become non-payers and then you're going to have other issues, right? So it's not always the best thing to brag about. Hey, we have a lot of additional income from late fees. Like, yeah, it sounds nice and maybe look great on paper, but I mean, like, great to receive that income, but on reality, that's not where I want my additional income coming from. Also, this is really important too when you're finding out and asking questions of, hey, is there additional income? Where is it coming from? Great. Now you can find out. And when running comps, I think this is really important as well, is what are other places charging outside of the rent? What's normal in that market? What's normal in that city? And in the area you're looking at a specific deal on, um, that's very that's a great way to compare two properties as well and two rents because what if you can't say your rent is 1,500 where across the street it's 1,500 but they have a free gym and laundry inside each unit, or whatever the case is, and parking that they don't pay for or charge for. But what if you're trying to charge for the gym or charge for parking or charge for XYZ? And I was like, okay, now you're not comparing the same thing. You have to be better, right? Either the unit has to be better, some other amenities that have to be better because you're not comparing the same thing. Um, and obviously in those cities, like big cities and major markets, you're gonna have so many options that there's no like, you can have 5 buildings on a street, each of them have their own different things that people prefer, whether it's the parking, the laundry, the pet park, the playground, the X's and O's, right? So keep that in mind too with the additional income is you're gonna use that to compare a lot of and run comps with other properties. Additional income is one that would be on the T12. Um, Vacancy concessions, T12, and then the rent, like we mentioned, on the rent roll. This is one that as you get more comfortable with, I personally like to do per deal because there is no real generic rule of thumb of how on the T12 the expenses are written out and how they group them. And when I'm comparing the two, I don't like to guess what they meant. It's just this is what they wrote, this is what it is, and this is the number. And if there's anything missing, obviously you want to ask about that. That's another great thing to start that whole broker relation and start the conversation going. Like, hey, I noticed there's no management fee, which is usually one of the first things you look for because especially if they've had the property for a long period of time or it's the only property they own, people just prefer to self-manage. And that's just what they do. And it's like a fun project until it's not anymore. The 120 unit was self-managed. So if they don't have a fee, you have to factor in, oh, we're gonna need that there. And whether you think you're not gonna do it or oh, someone else is gonna do it on the team, and no, put a fee make it realistic. If you get 5 quotes and they all say between 4 and 6, write 7 because it's not gonna hurt. You're only gonna be happy you got that extra percent later on. Or what if something happens and you may need that extra percent for whatever it is and other expenses related to management, not just any expense.
Yeah. And if a one like percent extra hurts you too much in the deal, it's probably a bad deal.
Correct. That's a good point too. See, we don't add these little nooks and like little amounts here and there just because why not throw it in there? It's the accumulation of each of these that you want because these things can all realistically go wrong. Your management quote can be high. Insurance quote could be, dude, that's the one you have no clue about half the time, and you don't really have a choice until it's too late, to be fair. You're not gonna know. Um, and things of that sort. So keep that in mind where you're putting all of these buffers in place for the total amount to say, hey, this is a good deal. Um, one thing you hear a lot, and I'm sure you guys have heard before, it's I was told this right away when I got into this space. Once a contract or deal you think is good, you're at the PSA and you're in escrow, you have to do everything possible to kill that deal in escrow. I have dotted every I, crossed every T. I've said 100 things can go wrong, and I still think this is a good deal. Or your worst case scenario is tolerable. Obviously, like that's what it comes down to is what's my worst case scenario. That's when you're like, okay, this is a good deal. But if you go through that and it's like the place can burn down after like you went through a quarter of those possible issues, okay, maybe it's not as great of a deal, or it's just a risky one, which is for some people, they may stomach that. Others may be like, there's no way I'm doing that. Especially your first one, you don't want it to be your riskiest. Like that's let's be fair with that as well, that point as well. So what I was saying with this is essentially on the T12, you're gonna get a list of their expenses. Some are very long, sometimes unnecessarily long, and some are shorter than they should be. And it's like, where's the rest of it? Um, the shorter obviously being a bigger concern, but the reality is it's the information you're given. And that's that.
Yep. And if I can, thank you, Ed. So as he's saying, like there's so many of these things that one they could be called different things, but like as Ed has on this screen right now, payroll expenses is at the top. I want to point that out as something that it's an area that a lot of people falter on when they're doing their underwrites, specifically payroll and salaries, because more the more inexperienced and novice underwriters, they will account for a salary. Okay, $50,000 a year for a property manager, just to make a number easy. But are you accounting for payroll taxes? Are you accounting for 401k matching? Are you and benefits? And are you going to do a bonus structure or a commission structure if they just kill it in leasing the property up? Or you have to think about every factor that goes into that the human resources aspect of your property, because I've seen plenty of underwrites that you'll look at and be like, oh wow, it's like 1,200-1,300 a door overall for payroll, but then when you actually add on these other things, it's like 1,900 a door in payroll, or like salary, benefits and taxes and all that stuff, employer side taxes. I mean, it's generally 15 to 20% on top of whatever each member's salary is, and then you have to figure out those other compensations that you might be providing. So there are layers to some of these items that you have to verify. And then again, if it's a seller represented by a broker, as a broker, we're here to tell you, like, look at the OM, because that OM is probably going to be full of like another page that's just their assumptions, and the assumptions are used to make it look pretty. When you have too much repair and maintenance, oh, let's just give the industry standard of 300 a door. But in reality, that property is dilapidated and the owner's spending 800-900 a door, annually to maintain. So all these are just additional factors to remember to never, trust but verify, never take it on the surface, dig with questions, dig with the brokers and the sellers directly if you're lucky enough. Dig with them until they start sounding a little bit annoyed of like, hey man, why are you asking so many questions? It's like, well, because I actually like your property and I want to buy it, but I gotta make sure it's right. Like they're not gonna hate you if you answer it that way. They're gonna question you if you just say, well, I just gotta ask you a million questions. But if they understand why, and you're like, look, I'm genuinely interested in this and I'm trying to find a pathway to writing you a letter of intent, then they're going to continue to feed you as much information as they need to get that letter of intent.
No, definitely. Um, and again, it gets easier the more you do it. It's like just the reality of it. And also like we say so many times, and I've said 1,000 times at this point, is knowing your market is really gonna allow you to understand like, hey, does this make sense? Hey, does that make sense? Like that's a big component of it too. With a lot of your general like fixed expenses too. So keep that in mind. Um, and then also think about this, and I think I've brought this up fairly recently too. But on the expenses side, when you get an expense percentage, and remember that ratio is reflective of the income. So if the building has high vacancy, if it has low rent, if it has low income, and the income is not supported, is not strong, naturally your expense ratio is going to be drastically higher than it may be, even if once you play with the numbers, the total expense number may be higher, but the ratio is now smaller. So keep that relationship in mind as well. And that may sound a little confusing. So if you guys need me to clarify, let me know. But the expenses are really relative to the income as well when you're looking at the ratio. So don't let that number scare you, but also like understand what does that look like and why is it that? Okay. So see, the other thing with expenses too, where it does get tricky is on the repair and maintenance side. And these are just kind of tying it back to like what we were mentioning with the T12 and where it's going to correlate to the relationship and discussion with the broker is, for example, repairs, maintenance, um, utilities kind of, but also with any other things that may be shopped around and are not as static and variable, like insurance and tax, where that just is what it is sometimes. But repairs and maintenance, like, okay, what was repaired? How often are they having call for repairs on units? Also, you will see repairs and maintenance and then turnover. Those are two very different things. Turnover is unit 100 left and we made some improve like clean some stuff up, touched it up, whatever it is for the next tenant, because you're not doing a full, it's not really repair and maintenance, it's more of a turnover for that unit. Repair and maintenance is like, hey, someone's living in there and something broke, or you had to go repair something, obviously maintenance, whatever it is. So keep in mind that difference, and keep in mind that if those two numbers are either really high or really low, why is that? Okay, that's one thing you, and also what I like to do with the repairs and maintenance, especially, is it's one of the easiest things on the T12 to ask about, because you can see just on one line if there's any drastic spike or dip month to month. If every month it's 5,000, all of a sudden you get a $35,000 month, you're like, what the heck happened here? And then now you're receiving more information on the property, which is never a bad thing. You can never know too much about a property. Um, Obviously, you're not going to find out everything before you actually pursue it. You're not going to want to spend that much time, but that is something to keep in mind on the repairs and maintenance side, where you can really find out a lot about it, and find out how much of it's exterior. Because as much as we want the units to be repaired, maintained, turned over, the real appeal and the first thing people see when they're coming to lease a unit, they're pulling into the parking spot, the guest parking spot for the leases, whatever it is the exterior. and those exterior things not only will attract the future potential tenant, and hopefully garner the most rent possible, but it could also be preventative on any damages that could happen to roofs, any roots that become an issue. Parking, the worst thing you can do is when you pull in to the parking lot and you're worried you're gonna get a flat or scrape or it's ugly or it's broke, it cracks everywhere, whatever the case is. These are all your first impression to your future tenants, but also will become some of the biggest expenses if they've been avoided for so long, right? Deferred is the word I was looking for. So keep that in mind. A lot of stuff go into that.
Parking lot resurfacing, restriping,
Mhm.
broken curbs, like you had said. Are there drainage issues? Do you have to get, storm drains sucked out or different things? And the larger the property, the more of these infrastructure related expenses you're going to have to assume will need to be incurred. So don't just think, oh, look, this property looks great, we don't have to do a lot. Always assume the worst under the surface, and that'll put you better for wear, because the best way I could put it is this: when you especially if you're trying to do it as a syndication, if you are bringing money together for capex, that's it. That's your limited budget. Unless you want to be that operator that's doing capital calls, you don't have the chance to come back and say, hey, I misread this deal and I need an extra 100, 200, $5 million, whatever it is, to get it done right and follow my business plan. You have one shot, and that's made right now in the underwriting, creating a budget. This is the beginning of your business plan. So take it very, very seriously as you're determining what you need to do.
Definitely. You can really get lost in a T12. That's another thing to keep in mind. Um, you can also get lost in underwrite. Don't spend more time you feel like you need to on a deal as either. Like at some point, just be like, okay, is this gonna work? You kind of get an idea. Now, maybe if you want to dive in and just take a look at the numbers to build that rapport and discuss with the agent, sure, that's a possibility. Um, but at some point you will start to realize like, hey, maybe this isn't gonna work. So don't spend $100 on something that you don't have to, please, because that the goal is to underwrite more qualified deals and not waste time with the less qualified. Um, Real quick, this is the debt service. This is where the lending component comes into play, or if you have the assumable loan, you want to make sure this is accurate. You want to make sure that the interest rate, the debt service, generally like this stuff is taken care of. And if you have an assumable loan and that's what's being marketed, you should be able to see their loan docs. It's like a 70-page, 50-page document. Luckily for us, all of the important loan information we need regarding like plugging in numbers and doing the underwrite is all on the same page almost for every doc. So it's around like somewhere in the 20s. So once you find that page, it'll really have it outlined. This is the interest only period. This is the rate. These are the other terms. And I'm not saying skip the rest of them, but if you're still doing the underwrite and you're not doing due diligence, having those numbers is what you're really worried about. Unless there's any odd or out there term on the assumable, which hopefully the broker is going to tell you about, which you should also ask about anytime there's an assumable loan. If the broker doesn't know, find out from the seller. And if they don't know, have them ask the lender. I don't know. Because at that point, like somebody has to know the answer. Like you can't market the assumable loan and no one knows nothing about it. And you want to know as much as you can about it, especially if you're thinking about pursuing it, because no two loans are ever the same. I feel like Kevin has a lot to say about that. Because the assumable loan part is not as easy as it sounds on paper.
Yeah, I would agree. And I do apologize, everybody. Ed, I gotta jump.
Okay.
I just got a message, but thank
Okay,
you
go
all
for it.
so much for coming out. Ed can continue to go through a little bit more and do a quick Q&A, and I'll see you guys in 2 weeks.
Yeah, I'll wrap it up. Take care, Kev. Um, any questions on like the assumed loan and anything up to this point? And then real quick, I'm going to show you guys a P&L. We might go a little over because of that, but it's not going to be too much, and I'll be quick about it. If you guys have any questions, please throw them in the chat or just shout out at me, and I'll be listening. But the reason why I was mentioning before that the taking the gross, let me show you guys, taking this as the gross potential rent and why this is so important is because of this part. Because that gross potential rent is taken from there, summary D4. So it's taken from there and put here. So if you tell me, and we're looking at property, and you say, based on inflation, the area, whatever it is, every year the rents are gonna automatically increase 3%. The problem is if you take that 3% and you're adding it to what its current rents are, which from the example I used before of 1,000 currently and 1,500 market, you're behind by 500. And if you're going to increase 3% every year, you are forever going to be behind and never get up to the market rent. That's the point of this model of showing the year-to-year growth of not only the property, but of how you're improving that on the spreadsheet. It should not be stagnant, and it should not definitely not be decreasing year on year, or getting further away from the market, which it will naturally, right? Because 1,500 and 1,000 both increased by 3%. Your margins are going further away, not closer. So let's say this is 3%. And now, okay, I'm happy I have it like this. So if in the first year, my vacancy is at 10%, my concessions are at 5%. My rent is gonna increase every year, my market rent. So it's 11.95, then it's gonna go 12.31, 12.68. But my current income is not that. Where you would make this adjustment is right here. If let's say you acquire this property, it's at 80% vacancy. Well, actually, in this example, it's 90. So let's say it's 90%. The following year, you bring it down 5%. So if you have this at 5% now, you have shown that increase through vacancy. So now your overall income is going to be better. And let's say in the same year, you're able to decrease your concessions, loss of lease, and bad debt from 5 to 2. So now you're getting closer to that market rent because you're not there yet, right? So that's where you make the improvement. And this is where you're going to see the most improvement on a year-to-year basis if you're acquiring a property that has high upside. Because remember, vacancy, very straightforward. Vacancy is properties vacant. What percentage of the year are these units vacant? Concessions. Concessions are if I'm giving out a promotion because I have to rent this unit, that cost has to go somewhere, right? It goes into concessions. Or if I'm trying to incentivize tenants through XYZ mean, that's going to cost me money to rent a unit or whatever the case is to maintain the property, you put that cost into concessions. Bad debt is just not collected rent. That's why having high bad debt is going to take you further away from your market rent because it's income you're not receiving. Remember, you have gross potential income, the bad stuff in the middle, and then what you receive. Sorry, gross potential rent and your potential income. Income is what you actually receive. Rent is what you're hoping to get. And then loss to lease is your difference. So if you're 1,500 market rent and you're at 1,000 actual rent, what you receive, your loss to lease is that 500 delta. Okay. And now you multiply that by 100 units, that's where you get a larger number. And that's where this percentage comes from. So you then want to project moving forward that you're going to improve both of those numbers, thus increasing your income and making the deal look better. And then that's when your expenses ratio and how you adjust your expenses will reflect that. I really hope I didn't lose anyone there. but for the most part, that's essentially what so that's essentially why it's really important to in the beginning say this is what our market rent is, um, not what we are currently receiving. Because then you'll never get to market rent. You're just gonna be going further away from it. Um, so keep that in mind on that. These numbers should be on the T12, like I mentioned. These are also where you're gonna see a lot of the value on the that is really where your upside sits. Is how can I increase the rents? How can I make sure vacancy is not terrible? And don't get me wrong, from year 1 to 2, you may not go down and you may even go up in vacancy because you are doing a lot of rehab. That's fine. Prepare for that. But also, that comes down to what resources do you have? Do you know how long rehabbing a unit will take? Do you know how many of your leases are coming up to where you can even remove someone to out of a unit and have a unit available to rehab? Like you can have a plan to rehab 10 units within the first 4 months. But if you don't have 10 units available to remodel or to rehab, doesn't matter. And then you also have the money for it, which is another problem. But you guys get my point. So any questions? If not, I'm gonna wrap it up there. But any questions regarding just general T12 rent roll, anything specific on the number side of like, hey, I've seen this, not sure what it is or where it goes or why it is what it is. Um feel free to go, I guess, ask away.
I do have a
If
question,
not,
Ed. Let me know
yeah,
if
of
you can
course.
hear me. Yeah.
I can hear
What
you.
what is your take on, when your analysis or the expenses don't reach that like 50% um or 55% rule of thumb? I've come across a few properties and they're just, even one of them, everything looks great, but we're at like reaching 30% in expenses in comparison to income. So what do you do with that?
You're reaching what percentage? Sorry.
Like 30% of in expenses.
So the first question would, so where I would look on that is, so what expenses, are there any expenses that have been excluded from what you are implementing in your underwrite to what would not normally be? And then I'll ask is, because a lot of your expenses, when you look at it, they're gonna come, your big ones. Insurance and taxes is gonna take a large chunk of that. Just it is what it is. So, okay, are those numbers accurate? Because remember, when every state, every city, everywhere has their own different tax reassessments. You want to make sure that's accurate. Now, if I'm not saying it has to be at 50, but it is something where you're like, okay, I have to make sure everything is right and like I've checked all the boxes because once you add tax, insurance, property management, repairs, um, uh well, this one's not the best example, but any other expenses such as utilities, utilities alone is going to be a big chunk too. So once you have all those done, you should be over 30% almost right there. Now, if they're all generally low, is it not that they're falsifying it, but it's like, hey, are these accurate? Double check with like that broker, for example. Or I'd also go to the as far as saying like, maybe one thing I've seen too is, let's say I have a building where the tenants are paying for utilities, you receive the income, but no one else is paying for the utilities on the back end. That's
Yeah.
a problem too. Because if I'm like if it's a RUBS or it's a reimbursement, it literally says reimbursement in the acronym. Reimbursement means I have to pay for it first. So if there's no expense going out of the utility, but there's only income coming in, that's not reimbursement. You're just charging for utilities but never paying for them. That doesn't work, obviously. So I've seen
Yeah,
that.
I think that's part of the reason why they're low, because in this case for this property, tenants pay directly, right? So it's everything is sub-metered.
So let me ask this: is what they pay documented anywhere on the income side?
In terms of, you mean
Additional
like the
income.
tenants so yeah, barely any additional income or other income, very little, like
So it's just a
60K.
wash. Okay, so that's something to keep in mind. Like, so that makes sense too, because normally your utilities will push that up, even if there's an income to offset it. Um, without seeing it, I'm kind of just spitballing like different things I've seen. But a lot of it does come to, well, my next question is then how much upside is there really on the property? So that's another question. Like if I have a new building, I hope it's at 30%. If I have a building that's not operating as great, 50% makes more sense. So then it just comes down to what class is the property, what's the upside, is there things that you can like that will increase as you take over? Like, do they have management? If they have management, is it a realistic price? Like, if you went out and got that quote, do they have on-site staff? Like Kevin mentioned earlier, you're gonna be hands off. There's some I'm not gonna go looking for it now. Let me just stop staring at my screen. But there's a lot of underwriting I've done where we have a management fee, you have a payroll in addition to support the management because they're managing the asset, but then they're gonna hire a leasing agent. They're gonna hire a repair guy that's gonna be on call, like not even on call. They're salaried, especially once you get to like 7,500 units, you have to have people on salary. You can't just call whenever they're available, they come in. That's not gonna work. If
Yeah.
you have 100 units, there's likely something's going on at all times, especially when trying to turn over units. Then you're going to have people paying for that stuff and managing that stuff and making sure they're aware of that. There's a lot of expenses there, especially like manpower, for lack of a better way to put it, that is going to increase that expense ratio. How many units
Yeah.
is it?
It's 46 units. So, right, like I'm just trying to figure out what would cause them to be so low. But for instance, just to kind of give you a quick run through, it's 46 units. It's like 32% occupied. So there's a lot of units that are still going under renovations, and then some are just vacant. Very interesting property. The thing about it is that I'm going based off of information that was posted back in December. So I reached out to the broker waiting to see if they'll send me an updated rent roll and T12. But based on the information that they shared, the property is still kind of, I think it's like, I want to say like 14 units going under renovation. Everything should be done by the time of closing, they say, but it's very low in vacant in occupancy. So I'm wondering if that's the reason why the expenses are so low. I don't know if the SDA breaks it down to that level, but I mean everything has been accounted for, including management fee, no payroll, but it's I have it at 8% management fee, which is I think fair for a 46 unit property.
Okay, so that's a good point because so here's my initial concern. What state is this in?
In North Carolina, so it's Charlotte
Okay.
area.
Okay. My initial concern is when you have that low income, your tax and insurance should have even more weight on your expense, like have more weight on that percentage.
Yeah.
So it's kind of like I was saying, I think I said it today, where if your income is low, your expense ratios should look drastically high because there's fixed expenses you can't get rid of, aka insurance and tax, right? So that's the first place I would look. Are those numbers too low? Are they paying a low amount because they bought this 15, 20, 30 years ago? And when you purchase, it's going to get reassessed? Because one thing that the T12 and every broker can very easily mislead their marketing on is assuming that or relaying the impression that you're going to pay the same tax as the current seller. That is not the case. And it's not always the case, almost never the case. You buy property, there's a good chance it is going to get reassessed. That's how it is where I live. You're paying a tax on new purchase price, not on what they bought it for 40 years ago. That right there could be a drastic increase just on that expense. So the first place I look is taxes. and insurance, because those can, especially when your income is low, are going to carry the most weight. Because those are just fixed costs and they don't care how many of the units you have vacant. You know, that's the big part of that.
Yeah.
Let me share
Yeah,
this.
so basing it off of their pro forma, they're at, 28% in total expenses. And, then me kind of going through line by line, assessing my projections, I get to 30%.
So
So,
that's where
and
it
it's
goes.
not, yeah,
So I was gonna say that's where it goes the other way. It's because everything's so brand new, your expenses are gonna be less. You're gonna have
right,
less repairs. Your value is gonna be so much higher than your actual tax bill because of the price you're acquiring at. Like, let's say you buy the property for 2 million, just for easy numbers. But the property, once you put all this rehab in, you increase the rent, you fill up the remaining 60%, 70% vacancy, and you're stabilized. Maybe it's worth 5, but you're still paying the tax bill when you bought it at 2. Let's say
right,
even 1.5. Your tax bill remains the same. So it's like the best way to look is like a flip, right? If you're buying a flip for 300, you put 50,000 into it and it's worth 800, 700, whatever, just bad example, but you get what I'm saying. You're paying the tax bill for $300,000 property, but you're living in a 7. So that's where your tax can carry so little weight when your income is so big, because it's the income of a 5 million, not the income of a 2.
right,
So that's where those, so for example, and this is why I said new builds. A new build is going to carry the smallest tax bill possible because there's nothing there before, right? So your tax bill is very minimal. And your insurance is actually probably going to be the lowest it'll be because you have the most updated and code and insurance stuff, and that whatever material, it's up to today and you're going to be the most safe, right? On paper. So given those factors, new builds are going to have low expense ratio. And if you're remodeling or rehabbing 70% of the units, you'd hope you're on the better side of the expense ratio
yeah,
than the higher end. Now, I would even say if you're at 30, how does it look if you're at 35, 40? If something goes wrong? Does it still look good?
right,
You
right,
don't have to justify 30% and say it's 30%. I can't find anywhere else to add this percentage. Okay, add 5. I just make up something, put in an expense, other,
right.
and see what happens. Um, and then that'll allow you to play with it and like, okay, I have a buffer, or make sure you have your reserves in there. Make sure you have like, so here, for example, you have payroll, which is not a factor there. You have tax, obviously that's a factor. Legal is not a factor there because you don't have anyone to kick out or have any legal issues with.
So I did
Ad-
add some legal fees, yeah, but yeah,
yeah. So advertising, they're not advertising because they're not renting their units right now. Contract, not really, because you're not, because it's all part of your rehab budget. So it's not reflective, it's not there either. Um, Trash removal, minimal. There's no trash to remove. It's all part of your rehab. So this is where you're eliminating a lot of stuff. And maybe they don't even have management. If you only have 30%, I can do that by myself. Like maybe they don't have management, right? Those are the reasons. So that's why, and also like to the broker, like this is a great question to ask the broker. Hey, I noticed the ratios at this. Are there things that you could see coming up when this property stabilizes that aren't on your current sheet?
yeah,
No? Okay, cool. Like it is what it is. If you want me to look at it, feel free to message me, or like I can see if I notice anything odd, like that I'm like, hey, why isn't this expense there, or whatever.
okay,
But up to you. That is a good question though, because that does come up and that does kind of throw things off, where you're gonna be on either extreme when a property is so like I guess so far away from stabilized to where it's like barely running. And then the other extreme where it's like now it's so brand new that your expenses are naturally going to be lower, and that's hopeful. If you're running 50% on a brand new building, you did something wrong.
Something's wrong.
Like your numbers just didn't work right because your income should make up for a lot of that. Remember, it's based off of the income. You know, payroll is the same no matter what the property is performing, right? If I need a leasing person to lease my units, whether it's a brand new build or not, that cost is the fixed cost. It's what's the cost of that salary. But now if my income is double, or it's my income's 30% more, that salary affects me a lot less. It carries less weight on my total on the ratio. And that's where it becomes it's a game of numbers at that point. And like basically the weight it carries. But I like that question. That's a good one.
Thank you.
I was just gonna I was gonna say bad joke, but it's fine. Any other questions? Because that's a tough one to follow up. That was a good question. I'm like, all right, anyone who want to follow that one up? If not, I'm gonna wrap things up. Cool. Enjoy. Always a pleasure. Always good seeing you guys. I'll see you guys in 2 weeks. Dude, we're in August. When did it become August? All right. Well, take care, guys. Enjoy. Have a good night, and we'll see you all Monday. Bye.
Thank you. Take care.
Take care. Bye.